Ladies and gentlemen, when it comes to silver, numbers tell the story that emotions often miss. I've crunched the math, examined the cycles, and looked at the forces shaping our economy. And the truth is, whether silver hits 333 or 600s is not just a guess. It's a matter of understanding the patterns, the policies, and the human behaviors that drive markets. Today, I'll show you the analysis that reveals the potential for a huge surge and why now, more than ever, strategy matters over speculation. When you look at silver, you are not just looking at a metal, you are looking at a mirror of human behavior, economic cycles, and monetary policy over centuries. The price of silver does not move randomly. It moves in discernible waves shaped by both tangible forces, such as supply and industrial demand, and intangible forces, such as human psychology, fear, and greed. History teaches us that silver, like other commodities, is profoundly cyclical. It rises when scarcity, monetary uncertainty, or inflation pressures dominate the system, and it falls when confidence, liquidity, and deflationary forces take hold. Understanding these cycles is not optional. If one seeks clarity, it is essential. The patterns of silver's history are remarkably instructive. Over the last several centuries, its price has reflected shifts in global monetary regimes. From the bimetallic standards of the 19th century to the gold-backed dollars of the 20th century, silver has alternated between periods of undervaluation and overvaluation. Each cycle carries lessons. When governments expand the money supply aggressively or when central banks suppress interest rates for extended periods, silver historically responds as a hedge, appreciating against currency debasement. Conversely, when economies stabilize and confidence in fiat currencies grows, silver often retreats as investors rotate toward more conventional assets. This is not speculation, it is observation. The forces driving silver are largely predictable if one studies the past patterns closely. Another critical aspect of silver's cycles is its dual nature as both a commodity and a monetary metal. Unlike gold, silver has a significant industrial component. Electronics, solar panels, medical instruments all demand silver. This duality means is that its price responds not only to monetary shifts, but also to the practical realities of industrial supply and demand. When economies expand rapidly, industrial consumption pushes prices higher, often magnifying speculative runs. When recessions hit, industrial demand slows, and silver often suffers steeper corrections than gold, despite its monetary attributes. Recognizing this dual influence is essential. Cycles are not purely about money. They are about material scarcity, production capacity, and the economic environment. Perhaps the most instructive element of silver's historical cycles is the extreme volatility that often accompanies transitions between phases. Prices do not move in straight lines. Instead, they surge during periods of panic or speculative mania and collapse when the overextension corrects. This is consistent with the principle that markets tend to overreact in both directions, exaggerating gains and losses before settling into equilibrium. Investors who ignore this behavioral dimension of cycles risk confusion and losses. Those who understand it can position themselves not just to react, but to anticipate. History repeatedly shows that the sharpest gains in silver come after periods of underappreciation, and the steepest losses follow periods of euphoria. Another dimension that history emphasizes is the interplay between silver and broader economic forces. Silver does not exist in isolation. It is influenced by interest rates, inflation expectations, geopolitical risks, and currency fluctuations during times of systemic stress, whether caused by wars, financial crises, or rapid decumulation. Silver often moves sharply as a safe haven. Conversely, in periods of calm, it may stagnate or even decline, reflecting confidence in the prevailing economic order. These oscillations are natural and expected. Understanding them is not about predicting exact prices, but about recognizing the forces at work and how they historically manifest in measurable patterns. Cycles also teach an essential lesson about timing and patience. Many investors enter silver markets at the peak of excitement and exit at the depths of despair, mistaking short-term volatility for long-term trends. Historical cycles, however, show that the most significant gains require discipline, analysis, and an understanding of where the market is within a broader context. Recognizing whether silver is in an accumulation phase, a speculative phase, or a correction phase allows for strategic decisions that are grounded in logic rather than emotion. This principle, though simple, is surprisingly underutilized in modern markets where short-termism dominates. Finally, history reminds us that silver's cycles are interrelated with other markets. Gold, currencies, equities, and bonds all influence the timing and magnitude of silver movements. When analyzing past cycles, patterns emerge where silver often anticipates or reacts alongside these correlated markets. The lesson here is interconnectedness. No market exists in isolation. To understand silver, one must understand the broader system, the flows of capital, and the feedback loops created by human behavior and policy decisions. These cycles, observed over decades and centuries, provide a framework to anticipate potential surges and declines, not as guesses, but as reasoned expectations grounded in historical evidence. In the final analysis, silver's history is a testament to the power of cycles, discipline, and systemic thinking. Prices move within patterns shaped by monetary policy, industrial demand, human psychology, and macroeconomic forces. Recognizing these cycles does not eliminate risk, but it gives clarity, structure, and a framework for strategic decision-making. Those who study silver's past with rigor gain insight into the potential for future surges, whether modest or extreme. And in a world defined by uncertainty, the ability to learn from history is not merely an advantage, it is a necessity. When you approach silver from a purely analytical perspective, it becomes clear that pricing is not random. It is governed by measurable forces, probabilities, and patterns that repeat over time. Understanding these dynamics requires more than intuition. It requires a disciplined examination of data trends and probabilities, as well as the relationships between silver and the broader financial system. Investing without this kind of rigorous analysis is akin to navigating a stormy sea without a map. Mathematical reasoning transforms uncertainty into actionable insights, and probabilities allow us to assess the likelihood of various outcomes, giving clarity in a world dominated by speculation. At the core of this analysis is the recognition that markets are not perfectly efficient, but they are predictable within bounds. Silver prices respond to supply, demand, inflation expectations, interest rates, currency fluctuations, and investor sentiment. Each of these variables can be quantified, and their historical correlations can be analyzed to produce a probability-based understanding of future movements. For instance, when real interest rates are deeply negative, meaning inflation outpaces returns on traditional safe assets, silver historically demonstrates strong upside potential. This is not coincidence. It is a mathematical consequence of the fact that investors seek assets that preserve purchasing power when traditional instruments lose value. By examining historical data, one can assign probabilities to various price levels under specific economic conditions, which allows for informed positioning rather than blind speculation. Another crucial aspect of mathematical analysis in silver is the study of historical cycles in numerical terms. Price charts, ratios, and moving averages are not merely lines on a screen. They represent aggregated human behavior and systemic forces over time. By analyzing the frequency, amplitude, and duration of past surges and corrections, one can build statistical models that estimate the likelihood of future price movements. For example, by measuring the percentage gains of silver during previous inflationary cycles and comparing them to current monetary conditions, a probability range emerges for potential future prices. This approach transforms what many consider guessing into disciplined, probability-weighted decision-making. The goal is not to predict the exact price tomorrow, but to understand the probable range of outcomes and their associated risks and rewards. Probabilities also extend beyond price levels to the timing of market movements. In any cycle, the market rarely moves linearly. It accelerates, decelerates, and occasionally experiences extreme spikes due to sudden shifts in sentiment or macroeconomic events. By analyzing historical volatility and the triggers that preceded rapid moves, one can assign probabilities to the timing and magnitude of surges. For silver, periods of monetary expansion, geopolitical stress, or industrial shortages tend to precede substantial upward moves. Conversely, periods of monetary tightening or economic stability often correspond with corrections. Understanding these probabilistic patterns allows investors to position themselves strategically, either by accumulating positions during low probability correction phases or preparing to capitalize on high probability surge phases. A critical component of this analytical framework is the use of ratios and relative valuations. Comparing silver to gold to the US dollar and to historical inflation-adjusted levels provides insight into potential mispricing. For instance, if the gold to silver ratio is historically high, the probability of silver outperforming gold in the next cycle increases. Similarly, by calculating the purchasing power adjusted price of silver across decades, one can assess whether it is undervalued or overvalued relative to historical norms. These mathematical relationships are not guarantees. They are probabilistic tools that increase the likelihood of making informed strategic decisions. Importantly, mathematical analysis also involves scenario planning. Markets are inherently uncertain, but probabilities allow us to envision multiple outcomes and prepare for each. By modeling different scenarios, for example, a moderate inflation surge versus an extreme monetary debasement, one can estimate the probability-weighted outcomes for silver prices. This approach ensures that decisions are not made based on emotion, hype, or singular narratives, but are rooted in structured reasoning. It also provides a framework to manage risk. The more extreme the potential price movement, the more careful one must be in allocation, timing, and position sizing. Probabilities do not eliminate risk, but they transform it from something unknowable into something manageable. By assigning likelihoods to various outcomes, investors gain clarity about potential gains, potential losses, and the most likely paths the market may take. This discipline allows for better decision-making in a world where uncertainty is constant. Historical precedent, combined with rigorous probability analysis, reveals that silver has historically rewarded those who approach it systematically, not impulsively. Finally, mathematical analysis teaches the importance of humility. Probabilities are not certainties, and models are never perfect. However, they provide a framework to think clearly, structure decisions, and understand the forces at play. In the case of silver, the data-driven conclusion is powerful based on historical cycles, interest rate conditions, inflation expectations, and relative valuations. The probability of a substantial surge in the coming cycle is significant. The precise timing or the exact peak cannot be known, but disciplined analysis shows that preparation now, positioning, accumulation, and risk management offers the highest probability of capturing upside while managing downside. In essence, understanding silver through mathematical analysis and probabilities is about seeing the market not as a chaotic series of price movements, but as a system governed by patterns, rules, and probabilities. Those who apply disciplined analysis grounded in history and systemic logic are far more likely to navigate the cycle successfully. Silver's potential surge is not a fantasy. It is the logical outcome of forces we can observe, measure, and understand, and probability-based reasoning allows us to anticipate it with clarity and confidence. Silver, like all commodities, does not exist in isolation. Its price movements are a reflection of the broader macroeconomic system, which includes monetary policy, fiscal policy, currency valuations, interest rates, global debt levels, and geopolitical tensions. Understanding silver requires viewing it not as an independent asset, but as a component in a complex, interconnected system. Its fluctuations are the outcome of multiple moving parts interacting simultaneously, often in ways that are predictable when analyzed through the lens of historical evidence and economic principles. Those who study these forces systematically gain insight into the probabilities of future surges and declines, while those who focus narrowly on short-term noise often miss the larger picture. At the core of silver's macroeconomic sensitivity is its role as a monetary and industrial metal. In times of monetary expansion, when central banks increase the money supply and lower interest rates, silver tends to appreciate as investors seek to preserve purchasing power. This effect is amplified in periods of negative real interest rates when the return on safe assets is lower than inflation. Under these conditions, holding silver becomes an attractive alternative, and its price reflects the collective recognition of its intrinsic value relative to fiat currency. Conversely, when monetary policy tightens, interest rates rise, liquidity contracts, or fiscal discipline strengthens, the incentive to hold silver diminishes, and prices often correct. These dynamics are not speculative. They are the natural outcome of systemic forces interacting with human decision-making. Another significant macroeconomic factor influencing silver is currency strength, particularly the US dollar. Silver is priced in dollars globally, so fluctuations in the currency directly impact its purchasing power. A weaker dollar makes silver cheaper for foreign investors, increasing demand and pushing prices higher. Conversely, a stronger dollar reduces global purchasing power and typically applies downward pressure. Historical patterns show that sharp movements in the dollar often precede significant swings in silver prices, emphasizing the importance of understanding macroeconomic trends, trade balances, and monetary policy decisions when analyzing potential silver surges. Global debt levels and economic stability also play a critical role. High levels of public and private debt, when combined with low growth and low interest rates, create conditions where traditional financial instruments lose appeal. In such environments, silver historically serves as a hedge, offering protection against currency depreciation, inflation, and systemic risk. Similarly, economic uncertainty, whether from geopolitical tensions, trade disputes, or financial crises, often leads investors to shift capital into tangible assets like silver, anticipating potential disruptions to the monetary system. Understanding these macroeconomic signals is crucial because they create the context in which silver moves from being a relatively quiet market to experiencing dramatic surges. Industrial demand interacts with macroeconomic forces to create additional pressure on silver prices. Global economic expansion increases consumption of silver in electronics, solar energy, medical equipment, and other applications. When industrial demand rises alongside monetary expansion and currency weakness, the probability of substantial price appreciation increases. Conversely, when economic activity slows, industrial demand contracts, and silver can underperform even when macroeconomic fundamentals are moderately supportive. This dual sensitivity to both economic cycles and monetary policy highlights the importance of examining silver through a macroeconomic lens. It is a metal whose behavior is tightly correlated with broader systemic forces. Inflation expectations are another critical driver. Silver has historically been perceived as a store of value against rising prices. When investors anticipate higher inflation driven by loose monetary policy, fiscal deficits, or rising commodity prices, they allocate capital towards silver, increasing demand and pushing prices upward. These expectations are not formed arbitrarily. They are based on observable economic trends, including money supply growth, velocity of money, consumer prices, and wage dynamics. By quantifying these factors and understanding their historical relationship with silver, one can estimate the probability and magnitude of potential price movements. Geopolitical events also influence macroeconomic forces, and by extension, silver wars, trade disruptions, sanctions, and political instability all affect currency stability, interest rates, and investor sentiment. During times of heightened geopolitical risk, silver often acts as a hedge against uncertainty, and prices can surge rapidly. These surges are amplified when combined with monetary and fiscal stress, illustrating how multiple macroeconomic forces converge to create conditions for dramatic price changes. Recognizing these convergences allows investors to anticipate the timing and magnitude of potential moves rather than reacting after the fact. Finally, it is critical to recognize that macroeconomic forces interact dynamically. Central bank policies influence interest rates and inflation, which affect currencies and investor behavior. Debt levels shape fiscal policy, which in turn affects economic growth and confidence. Industrial demand responds to economic activity, which is influenced by global trade and geopolitical stability. Silver's price is a synthesis of all these factors, reflecting the collective outcome of systemic interactions rather than isolated events. Those who fail to see these connections often misinterpret price movements, treating them as random rather than systemic. In conclusion, the macroeconomic environment is not an abstract backdrop for silver. It is the framework that shapes its price behavior. By analyzing monetary policy, currency trends, debt levels, inflation expectations, industrial demand, and geopolitical risks, one can form a structured, probabilistic understanding of silver's potential. The cycles of history, combined with rigorous macroeconomic analysis, reveal that surges in silver are rarely isolated phenomena. They are the logical result of systemic conditions converging to create a high probability scenario. Those who approach silver through this lens do not rely on luck. They rely on principles, evidence, and disciplined reasoning to navigate uncertainty and anticipate opportunity. When it comes to understanding silver, one cannot focus solely on charts, numbers, or macroeconomic forces. At its core, markets are a reflection of human behavior. Prices rise and fall not merely because of supply and demand, but because of the collective actions of investors, traders, institutions, and even casual participants responding to fear, greed, and perception. Market psychology drives volatility, creates extremes, and often amplifies the very trends that mathematical models and macroeconomic analysis anticipate. Recognizing this dimension is essential because it explains why silver can sometimes move far beyond its fundamental value before correcting, and why cycles are often sharper and more dramatic than raw economic reasoning might suggest. Human behavior in markets operates on both individual and collective levels. Individually, investors are influenced by cognitive biases, overconfidence, herd mentality, loss aversion, and recency bias. Overconfidence leads participants to believe they can predict short-term price movements, causing excessive risk taking during bullish runs. Herd mentality amplifies trends as individuals mimic the actions of others rather than making independent assessments. Loss aversion makes investors reluctant to sell during declines, intensifying downward pressure, while recency bias leads people to overweight recent price movements, exaggerating their expectations for future trends. In silver markets, these biases combine to create cycles that are often more extreme than purely rational analysis would predict. On the collective level, market psychology creates patterns of fear and greed that drive short-term volatility. When prices begin to rise, enthusiasm spreads quickly, attracting new investors who fear missing out. This often accelerates upward movements, creating speculative surges. Conversely, when prices fall, panic can lead to sharp sell-offs as fear overtakes logic. These extremes often result in rapid price swings, appear disproportionate to underlying fundamentals. Historical observation reveals that silver frequently experiences such amplified moves, reflecting the emotional intensity of market participants, particularly in periods of uncertainty or monetary stress. Understanding these dynamics is not merely academic, it is the key to navigating cycles strategically. Another critical aspect of market psychology is the role of narratives. Humans are storytelling creatures, and markets are heavily influenced by the stories that investors tell themselves and each other. Narratives about inflation, currency debasement, geopolitical crises, or industrial demand can create momentum as more participants adopt and act on the prevailing story. For silver, this means that psychological factors often precede or reinforce macroeconomic or fundamental trends. A compelling narrative can drive demand and prices before broader economic conditions fully justify it, while a loss of confidence in that narrative can precipitate sharp corrections. Recognizing the power of narratives allows investors to differentiate between short-term hype and long-term trend signals. Timing is particularly sensitive to psychological forces. Even when macroeconomic and mathematical analyses point to a high probability surge in silver, human behavior can delay or accelerate the realization of that trend. Individuals may hesitate to buy during early stages of accumulation due to fear, or they may overreact during the initial phases of a surge due to excitement. Markets tend to oscillate between extremes of underreaction and overreaction, creating windows of opportunity for those who understand behavioral patterns. By observing sentiment indicators, trading volumes, and investor positioning, one can anticipate turning points where human psychology is likely to shift from fear to greed or vice versa, influencing the trajectory of silver prices. Psychology also interacts with macroeconomic and systemic forces to amplify movements. For example, during periods of monetary expansion and low interest rates, fundamentals may suggest upward potential for silver. However, the actual surge often depends on the emotional response of investors to perceived scarcity, geopolitical stress, or currency weakness. Panic buying or speculative accumulation can push prices far above levels justified by immediate industrial demand or inflation hedging. Conversely, when fundamentals remain supportive but investor confidence wavers, prices may stagnate or decline temporarily. These interactions highlight that psychology is not separate from the system. It is a component of the system that shapes how and when trends manifest. Historical patterns reinforce the importance of psychology in silver markets. Many of the largest price movements in history occurred not solely because of changes in supply or industrial demand, but because collective human behavior reached a tipping point. During bull markets, participants often become euphoric, ignoring risk and exaggerating potential gains. During bear markets, fear can lead to capitulation, magnifying losses. These extremes create the cyclical patterns that sophisticated investors learn to anticipate rather than react to. Recognizing the interplay between human behavior, market psychology, and systemic forces provides a framework to navigate volatility with discipline and strategic foresight. Finally, understanding psychology underscores the principle of preparation over reaction. Silver does not move in isolation, and its swings are magnified by the emotional responses of market participants. By recognizing that fear and greed drive short-term fluctuations, investors can position themselves to capture upside while managing downside. They can anticipate periods of panic selling as opportunities to accumulate and periods of irrational exuberance as signals to evaluate risk. Human behavior, while unpredictable in the short term, follows consistent patterns over time, allowing disciplined participants to apply probabilistic reasoning and historical insight to decision-making. In essence, silver markets are as much a reflection of human behavior as they are a reflection of economic fundamentals. By studying patterns of fear, greed, herd mentality, and narrative-driven momentum, one gains a deeper understanding of why prices behave as they do, why cycles are often exaggerated, and how to position strategically. Market psychology transforms uncertainty into actionable insight, enabling disciplined participants to navigate volatility, anticipate trends, and capitalize on high-probability opportunities. Understanding human behavior is not optional. It is central to understanding silver itself. Investing in silver is not merely about buying at a low price and selling at a high price. It is about understanding the underlying principles that govern market cycles and human behavior. Every investor, whether seasoned or new, benefits from approaching silver with a framework rooted in rationality, discipline, and evidence-based reasoning. Principles provide a roadmap through uncertainty, reducing the reliance on luck and emotion while increasing the likelihood of capturing opportunities and avoiding unnecessary losses. These principles are not static rules. They are derived from observing patterns in markets, human behavior, and systemic interactions over decades. They offer guidance on how to think about risk, timing, allocation, and positioning in the context of silver and similar assets. The first principle is diversification. No single asset, no matter how promising, should dominate one's portfolio. Silver can deliver significant gains, particularly during periods of monetary stress or industrial demand surges, but it can also experience steep corrections. By maintaining a diversified portfolio that includes cash, equities, bonds, gold, and silver, an investor can balance risk and reward. Diversification is not merely a defensive measure. It allows participation in multiple opportunities while managing the systemic risks that inevitably arise in cycles. Silver, when viewed through this lens, becomes a component of a broader strategy rather than an isolated gamble. The second principle is risk awareness and management. Understanding the potential downside is as important as anticipating the upside. Markets are inherently unpredictable, and even the most probable scenarios can fail to materialize. Historical analysis of silver shows periods of extraordinary surges followed by sharp corrections. Investors who fail to anticipate potential losses or misjudge timing often experience emotional reactions that compound financial damage. Effective risk management involves position sizing, setting clear entry and exit criteria, and understanding correlation with other assets. It also requires a mindset that separates investment decisions from emotion, allowing for disciplined action even in volatile conditions. The third principle is the importance of cyclical awareness. Silver is inherently cyclical, influenced by monetary policy, industrial demand, investor behavior, and macroeconomic forces. Recognizing the phase of the cycle, accumulation, speculative surge, or correction, provides a probabilistic framework for action. For example, during accumulation phases, disciplined investors can gradually build positions at lower prices with lower risk. During speculative surges, one must evaluate whether momentum justifies continued accumulation or whether risk-adjusted exit points are prudent. Cycles are predictable not in their precise timing, but in their pattern, amplitude, and frequency. Understanding these patterns enables strategic decision-making rather than reactive trading. The fourth principle is the use of evidence-based analysis. Decisions should be grounded in data, historical precedent, and systemic logic rather than hype, rumor, or fear. For silver, this means analyzing supply-demand fundamentals, interest rate trends, inflation expectations, currency movements, and industrial demand. It also means considering psychological indicators such as sentiment, positioning, and narrative momentum. By applying rigorous analysis to these factors, an investor can estimate probabilities, anticipate potential outcomes, and allocate resources efficiently. Evidence-based reasoning transforms uncertainty into structured insight, providing a rational basis for decision-making in markets dominated by emotion. The fifth principle is preparation for uncertainty. Markets are inherently unpredictable, and even the best analysis cannot foresee every event. Black swan events, geopolitical crises, or sudden shifts in policy can alter the trajectory of silver prices dramatically. Therefore, principles for investors include building flexibility and resilience into strategies. This might involve maintaining liquidity, setting stop-loss thresholds, or holding partial positions to capitalize on emerging opportunities. Preparedness is not about predicting the unpredictable. It is about positioning oneself to respond effectively when circumstances change, minimizing losses while capturing potential upside. Another principle is patience and long-term perspective. Silver's most substantial gains historically have occurred over extended periods, often following years of accumulation. Subtle upward trends and macroeconomic buildup. Impatience can lead to overtrading, chasing peaks, or reacting to short-term volatility. By adopting a long-term perspective, investors can endure temporary setbacks, avoid emotional reactions, and benefit from compounding opportunities. Patience is reinforced by a disciplined adherence to other principles: diversification, risk management, evidence-based analysis, and cyclical awareness, all of which guide decision-making without succumbing to market noise. Finally, a principle often overlooked is humility. Investors must recognize the limits of their knowledge and the inherent uncertainty in markets. Silver, like any asset, is influenced by forces that cannot be perfectly controlled or predicted. A humble investor is willing to learn from mistakes, adjust strategies, and adapt to changing circumstances. Humility allows for flexibility in thinking, openness to evidence, and avoidance of overconfidence, all of which are essential for long-term success. Recognizing that probabilities guide but do not guarantee outcomes keeps expectations realistic and decisions rational. Applying these principles in combination creates a coherent approach to investing in silver. They transform a market that can appear chaotic and emotional into a structured environment where decisions are based on patterns, probabilities, and disciplined reasoning. Investors who internalize these principles are not merely reacting to daily fluctuations. They are navigating the systemic forces that govern silver's behavior. They position themselves to capitalize on surges while managing risks, understanding that outcomes are shaped as much by preparation, patience, and discipline as by external events. In essence, principles for investing in silver are about creating a framework that balances opportunity with risk, data with judgment, and action with patience. They are designed to help investors think systematically, act strategically, and respond rationally to volatility. Following these principles does not eliminate uncertainty, but it dramatically increases the probability of achieving favorable outcomes in a market driven by cycles, psychology, macroeconomic forces, and probabilities. Principles provide the foundation for clarity, confidence, and long-term success. At the end of the day, it's not about chasing hype or following the crowd. It's about understanding the principles that govern markets, recognizing the cycles, and positioning yourself wisely. The 333 or 600, both numbers tell a story, but only those who study the data and respect the forces behind the market will be ready for what comes next. Silver is signaling something big, and your preparedness today determines your opportunity tomorrow.